Okay, so we constantly hear terms like economics
Yeah.
and finance, right? And they get thrown around almost interchangeably, like they're just, two sides of the same coin.
Yeah, exactly. You hear them together all the time, but if you actually dig down a bit, you find they're profoundly different.
Right. It's kind of like assuming physics and engineering are the same discipline. They're related, obviously, but
Yeah,
definitely not the same thing.
absolutely not. I often think of them as like fraternal twins. They share that common lineage, the same roots maybe, but they grow up with these really distinct personalities.
Fraternal twins. I like that.
Yeah, they tackle problems differently. They have unique ways of thinking about the world, and you get some surprising insights when you see where they diverge.
That makes a lot of sense. So for this deep dive, that's really our mission, isn't it? To unravel those unique characteristics. Like, how do they actually think differently? What
Yeah.
kinds of problems does each one try to solve? And, what can we learn from understanding how they're different yet connected?
Hmm.
Ultimately, we want to help you get a better handle on these big forces that shape things around us, often in ways we don't even notice.
Definitely. Let's maybe start with just their basic orientation as like fields of study. Think of economics almost like the theoretical physicist of the social sciences. It's exploring these fundamental, sometimes pretty abstract laws about how whole economies work.
Okay, abstract loss. Like what?
Like consumer behavior theory. That dives into the principles of why people choose to buy certain things, given how much money they have. It's about the big underlying mechanics.
Gotcha. So it's foundational. It's the kind of general theory that helps you grasp the logic of how the whole economic engine is supposed to run. Its influence might be subtle, maybe you don't even realize it's shaping how you see things, but it provides that big picture context.
Exactly. It's the bedrock.
So what about finance then, if economics is the physicist?
Finance, in this analogy, is more like the engineer. It takes those fundamental economic principles and applies them. But to really practical, really concrete decisions,
Okay, engineer. Yeah. So less theory, more doing.
right? Instead of abstract consumer theory, finance asks, okay, how does a family actually allocate its money? How do you practically balance saving for a house down payment versus putting money aside for kids' education versus planning for retirement?
Ah, I see.
It's about building something tangible using those theoretical blueprints from economics.
So that sounds much more like a direct hands-on skill set,
Hmm.
the kind of thing a financial advisor would help you with specific actionable steps.
Precisely. And it's not about one being better than the other. They just serve different purposes. Physics gives you the laws of motion. Engineering builds the car. Both vital.
Okay, that distinction makes sense. Different purposes.
And it gets even more interesting when you look at their core, like mental models, how they actually think. Economics often focuses on optimization, making the best choice, but always under given constraints. Yeah, like the old saying, cutting your coat according to your cloth. You work within your present means. Careful budgeting, making the absolute best of what you have right now.
Okay, so the economics mindset is very much about living within the here and now,
Mm-hmm.
managing today's resources carefully.
Pretty much.
But finance, you mentioned it's different. It sounds almost like it operates like a time machine?
Yeah, that's a good way to think about it. Finance isn't just managing present resources, it's really focused on allocating resources across time, across different dimensions of time.
Allocating across time.
It tries to transcend those present limits using financial tools and instruments.
Okay, how does that work? That sounds intriguing.
Well, there's this great little anecdote I sometimes use. Imagine an economics professor married to a finance professor.
Okay.
The economics professor, true to form, meticulously budgets every single penny, living strictly within their current salary.
Right, cutting the code according to the cloth.
Exactly. Meanwhile, their finance professor's spouse might be using something like loan leverage, basically, borrowing money to bring future expected income into the present.
Ah, to do what? Maybe buy a bigger house now?
Precisely. Buying something today they couldn't strictly afford based only on their current income. It shows those two totally different ways of thinking.
Well, that anecdote really makes it clear. Finance isn't just about today's money. It's about moving value between the present and the future.
That's a huge part of it.
And actually, when you stop and think about it, this time machine aspect of finance is everywhere, isn't it?
It really is.
Mortgages. They let us live in a home now, even though we'll be paying for it for like 30 years.
Bringing future housing consumption into the present.
And student loans, too. Young people invest in education now, betting that their future earnings will be higher to pay it back.
Another perfect example. investing in human capital across time.
And even pension plans. That's literally setting aside income now to use way down the road in retirement. Finance really does shift resources through time.
It does. That whole concept, sometimes called intertemporal optimization, fancy term, but it just means making the best choices about using resources at different points in time. That's totally central to finance. It's not bound by today's budget in the same way economics often frames things. It actively looks for ways around those limits.
And their perspectives, their sort of focus areas are different too, right? Economics often feels like it belongs in, I don't know, the halls of power, national advisors, big policy stuff.
Yeah, that's a common perception. It's often concerned with macroeconomics, national development strategies, the really big questions.
Like what drives economic growth for a whole country? How do central banks control inflation nationally? These decisions impact millions.
Exactly. It's the grand strategy level. Finance, though, often feels more like the people's knowledge. It's much more focused on solving practical, everyday problems for individuals, families, businesses.
So less about abstract national policy, more about concrete actions.
Right. Like investment theory telling you how to allocate your savings. Or corporate finance, helping a specific company figure out how to raise money or incentivize its employees.
So finance is tackling questions like, should I buy this stock or invest in property right now? Or, for a business, should we issue bonds or sell more shares to fund this new project?
Exactly. Very practical, immediate decisions that affect us directly.
What's really fascinating, though, is how these two distinct fields with different focuses still manage to influence each other so much.
Oh, absolutely. That's where it gets really interesting. Despite their different lenses, they are incredibly complementary. Those big macroeconomic conditions, inflation, interest rates, overall growth, that's economics, they absolutely shape individual investment decisions, which is finance. And flipping it around, the combined effect of millions of individual financial choices, like everyone deciding to take out mortgages or sell stocks, that massively impacts the overall macroeconomy.
So they feed back into each other constantly.
Constantly. Think about the 2008 financial crisis. That wasn't just some abstract macroeconomic event happening out of the blue.
No, definitely not.
It grew out of countless individual mortgage decisions, people borrowing, lenders lending, often not very wisely. Those microfinancial choices aggregated up to create this enormous systemic risk that nearly took down the global economy.
Wow. Yeah, that's a really powerful example of how the micro and macro finance and economics are just deeply intertwined.
Totally. And given these different approaches and focuses, it probably won't surprise you that the way you learn these subjects is also pretty different.
Okay, how so?
Well, learning economics often involves getting a really broad exposure, especially, I think, to economic history. History kind of acts like a mirror. It shows you these recurring patterns. Yeah, like when you study the Great Depression in 1929, you start seeing some really striking similarities to what happened in 2008. It teaches you about cycles, about fundamental forces that seem to repeat over time.
So economics is about spotting those big recurring waves in history, understanding the underlying currents that drive them.
That's a big part of it, yeah, understanding the long game.
But finance, that sounds like it would be more about, I don't know, getting your hands dirty, practical skills.
Exactly. More like, say, how medical students learn through clinical rotations. Finance really emphasizes practice, mastering practical skills, working through real-world scenarios.
So less about historical patterns, more about mastering the tools for today.
I think so. You learn through case studies, lots of computational exercises, and these days, actual market experience is seen as really critical. You know, business schools like Harvard are famous for their case method that's pure hands-on, practical application of finance principles to messy current problems.
Okay, so they really are different ways of learning too. One looking back for patterns, the other focusing on doing things now.
But, and this is key, both are absolutely indispensable tools if you want to understand modern economic life.
Right. It's like you said earlier, the telescope and the microscope. You need both for a complete picture.
Precisely.
Like about choosing a mortgage, fixed rate or adjustable. You need to think about the likely future path of interest rates. That's macroeconomics. But you also need to figure out what fits your personal budget and risk tolerance. That's personal finance.
Perfect example. Or a company deciding whether to expand. They have to look at the overall industry cycle economics, but also figure out their specific financing costs and options finance.
It's always a blend in the real world, isn't it?
Always. And actually, speaking of understanding cycles and navigating crises, This brings us to a really fascinating case study. Let's talk about one of the most legendary hedge funds out there, Bridgewater Associates.
Ah, Ray Dalio's firm. Yeah, they have this reputation, almost mythical, for making money when everyone else is losing their shirts,
Yeah.
especially during big financial crises.
Exactly, they're famous for it. Which always leads to the question, how do they do it? What's their secret sauce?
They really cemented that reputation back in '87, didn't they? The October heroes.
That's right, Black Monday, October 19th, 1987. The Dow Jones just plummeted. What was it?
Over 22% in a single day. I've read accounts of traders just in despair on the floor, thought the world was ending.
Total meltdown. And yet somehow, Bridgewater managed to post a positive return, a 22% positive return for that month.
Incredible. That's where the October hero nickname came from, right? The media picked up on it.
Yep, and it wasn't a one-off. Fast forward to 2008, the subprime mortgage crisis, Lehman Brothers collapsing, Bear Stearns getting swallowed up.
Even Warren Buffett took a pretty big hit that year.
Right, but Bridgewater, they reportedly saw it coming, they navigated through it, and apparently achieved something like 14% growth in their main fund that year.
Again, profiting massively amidst chaos. It's uncanny.
And then again, 2010, the European sovereign debt crisis was really heating up. Their big, pure alpha fund, get this, reported a 45% return for the year on billions and billions of dollars under management. That kind of return on that scale is just astronomical.
Okay, yeah. One heroic call might be luck, maybe genius. But doing it multiple times across different crises, there has to be something systematic going on. There has to be a secret. What is it?
Well, the secret, or at least the core of their approach, seems to lie in a very particular framework for economic analysis. Unlike a lot of mainstream economics that might just extrapolate from recent history, Bridgewater developed this core belief. Their view is that the root of basically every major financial crisis boils down to one thing: debt.
Debt. Just too much debt.
Essentially, yes. When the total amount of debt builds up to a point where people, companies, or even governments can no longer realistically afford to pay it back, that's the trigger. It sets off this devastating chain reaction. Assets start losing value, confidence just vanishes overnight, and crucially, liquidity, the ability to easily buy and sell assets or get cash, dries up completely.
It's kind of like the personal credit card crisis analogy, maybe. A bit of debt can help you consume, smooth things over. But when your payments start to exceed your income, boom, crisis.
That's a very relatable way to think about it, yeah. Moderate debt can stimulate things, but excessive debt relative to the ability to repay is the danger zone.
So did they use this debt focus to see 2008 coming?
Apparently so. Based on this principle, they started identifying huge debt risks building up in the U.S. housing market years before the crash. As early as 2004, 2005, 2006, they saw that lending standards had gotten incredibly loose. Policies like zero down payment mortgages or loans with no payments for the first 2 years.
Right, those teaser rates and easy terms that sucked a lot of people in.
Exactly. They saw that these policies were allowing people with lower incomes who might struggle to repay later to buy homes. A huge amount of debt was building up, resting on a shaky foundation.
And then came the trigger.
The trigger. Around 2006, those initial easy payment periods started ending for many borrowers. The required payments jumped up. And crucially, this happened right as the Federal Reserve was in the middle of raising interest rates. They hiked rates 17 times in a row.
Wow, 17 times. From what, like 1%?
Yeah, from a low of 1% all the way up to 5.25%. So suddenly, millions of homeowners faced much higher payments they just couldn't afford.
And that's when the defaults started piling up.
Defaults surged. People couldn't sell their homes because prices started falling. The value of the houses, the collateral backing the loans, plummeted. This crippled the balance sheets of the banks and financial institutions holding those mortgage-backed securities. And that cascade led straight to the global financial tsunami. Their focus on the debt cycle was incredibly predictive in that case.
It really sounds like they found the magic formula, the holy grail of investing, just by focusing on debt cycles.
Well, it certainly seems like a powerful lens, especially for spotting crises, but like most things in investing, when you zoom out, the picture gets a bit more nuanced.
Nuanced how? Their long-term record isn't as stellar.
It's still very respectable, but maybe not quite the mythical status those crisis calls suggest. If you look at their flagship funds, Pure Alpha and All Weather, their long-term annualized returns are somewhere around, say, 12.8% for Pure Alpha and maybe 7.7% for All Weather, depending on the exact period.
Okay. And how does that stack up against just like investing in the broader market, or against other legendary investors.
Well, if you compare it to the S&P 500 index over similar long periods, Pure Alpha has generally done a bit better, but all weather has actually lagged behind the simple market index.
Interesting. So one beat the market, one didn't.
Right. And then if you compare it to someone like Warren Buffett, his average annual return over like 50 years is closer to 22%. And he was managing vastly larger sums of money for much of that time.
Okay, 22% versus maybe 13% for Bridgewater's best fund. That definitely puts it in perspective.
It does. So the critical takeaway, I think, is that Bridgewater's real standout advantage seems to be primarily during those periods of intense crisis and transition.
Their knack for navigating the storms.
Exactly. Their performance during more stable, normal market years seems to be, well, less remarkable, still good, but not necessarily world-beating consistently.
So they're crisis specialists, maybe. That highlights a specific strength, but not necessarily universal outperformance all the time.
That seems fair. And it's also worth noting, interestingly, that after Ray Dalio started publicly sharing a lot more detail about Bridgewater's analytical methods and principles around 2013 or so, their performance actually seemed to decline somewhat noticeably. It wasn't quite the same magic touch.
Maybe letting the secret out of the bag reduced their edge. Or maybe the market's just changed.
Could be both. It really makes you think of that old saying from Heraclitus, the Greek philosopher, "No man ever steps in the same river twice." Markets are constantly evolving, constantly adapting. There really is no permanent, holy grail or magic formula in investing that works forever.
That's a really powerful lesson, actually. So while Dalio's principles about debt cycles and understanding history are clearly valuable, the Bridgewater story also tells us there are no permanent champions. Achieving truly consistent, long-term excess returns seems to require more than just mastering one specific cycle or framework. It's maybe about multidimensional thinking, adapting.
I think that's exactly right. Understanding deep cycles, like the debt cycles Bridgewater focused on, can absolutely help you mitigate risk, maybe even spot opportunities others miss. But true, sustained success probably needs a broader, more adaptable approach.
So recapping that, we've talked about economics as providing that foundational understanding, those sort of abstract laws, the why.
Right, the big picture, the invisible levers.
And finance is the practical application, the engineering, the tools to make concrete decisions, almost like that time machine for managing money across our lives.
Exactly. Taking the theory and making it work in the real world. And both are absolutely vital. You can't really understand modern life without appreciating both perspectives.
They really are intertwined. And while understanding cycles, like Bridgewater did with debt, can definitely help manage risk and maybe find an edge. The bigger lesson seems to be that mastering modern economic and financial life really demands embracing a truly multidimensional perspective. It's about recognizing that no single theory, no single strategy, no matter how brilliant it seems for a while, is likely to be a permanent fix or a guaranteed path to success. The world just keeps changing.
That's the fundamental truth, isn't it? The landscape is always shifting under your feet. So maybe the thought to leave everyone with is this. Now that you've thought about the interplay between these intimate yet distant twins, economics and finance, and considered the ever-evolving nature of markets, how might that change how you approach your own financial decisions? Or even just how you interpret the economic news you hear every day?
Yeah, how does seeing both the big picture and the practical tools and knowing that nothing stays static affect how you navigate it all? Something to definitely chew on. We genuinely love to hear your thoughts on this. Jump into the comments section and let us know what resonated. Which type of wealth are you focusing on?
Yeah, let us know.
And hey, if you found this discussion useful, maybe learned something new, definitely hit that subscribe button. We do these deep dives regularly, exploring valuable ideas.
We appreciate you tuning in.
Yeah, thanks for joining us.